Hey guys, Jay here, smarthelping.com. I've got a cool real estate model for strip mall acquisition. The main purpose of this model is to purchase an existing strip mall, do renovations, some value add work, and then raise the rents. Uh, that's what it's for, and that's exactly how the model was built. Up to 30 tenants it can handle. We've also got options for debt and refinancing. We've also got options for a cash flow waterfall as well as GP fees and two waterfall options here. So let's walk through. It's strictly cash flow. We're not doing balance sheet, um, pro formas necessarily. I mean, you could consider this a pro forma, but it's not going to be connected balance sheet, cash flow statement, income statement. It's mainly just to figure out what's your cash flow, what's the deal analytics, what's your IRR, equity multiple, uh, and then I also show a cash on cash each period. Okay, so all yellow cells are editable, and we're just going to walk through each assumption. Also keep in mind these assumptions in yellow I have right here are arbitrary. They mean nothing. It's just inputs. When you go to use this, you'll put in your own data. And also, if you do purchase a template, all of these will be zeroed out, so you can just start with your own information and you don't have to re-clear all this out before you start working on it. Okay, so let's go through the input. So we got address, so whatever address it is. We've got your purchase price. Um, let's say $2 million. We'll go through a new deal. Let's say it's 200,000 square feet. Purchase price $10 a square foot. This section here is for lease up costs. So let's say, let's zero these out for right now. Let's say when you buy it, um, there's maybe 6 or 7 vacant retail spaces for your strip mall. You may have to pay property taxes, insurance, some other costs that might be covered if you're doing triple net lease terms when you do sign tenants, so that they'll pay those expenses. But until you sign them, you might have some costs that you need to account for here that are only going to happen for a certain amount of time. And this model has all cash up front, so all of the cash outflows and or cash requirements are all going to happen in period zero here. Everything from the purchase price, all the debt stuff, renovation costs, leasing commissions, closing fees, acquisition fees, general reserve, lease up costs, which I just went over. All that stuff is going to happen in period zero. So we can easily say, okay, how much cash do we need up front? And then let's model out the operations over time based on all these different things, which we'll go through. Now there's also, once you get stabilized, you can put in here expenses, your stabilized expenses, and you could define when those start and what your annual cost per square foot is, as well as the annual expense increase. Now this will be what the landlord has to pay once, let's assume you are fully leased up, and what you expect to have to pay over time. And it doesn't have to be triple net lease, but it might be, it could be full. You know, tenants are paying everything, and in that case, this would be a pretty low number, or it could be higher if you're not doing those. But this expense is what you see ongoing right here in row 18 on the monthly detail. So those expenses start, and why do we have those happening not in period zero, is because we are currently accounting for lease up costs happening here, which is going to account for a lot of those things. And then this is, because we have to have some way to say, okay, for some amount of time, our expenses are going to be X. And then once we're stabilized, our expenses are going to be Y. And this initial budget is happening all up front. So let's say you have, and this is for the entire strip mall that you purchase, not just per unit. This is the entire cost. So let's say you got property taxes of $10,000 a month, and let's say you've got insurance of maybe, oh, who knows, 2,500, and let's say you got to pay that for 5 months, and then this should be somewhat close or relative to what your stabilized is. And then let's say after 5 months, you think you'll get all the tenants up. And okay, so then we'll go say in month 6, these costs start. And this is quite a bit higher. Let's lower this just to be in line. So this is 62. Maybe when you get it all up, it's going to be maybe 41,000 a month. Oh wait, no, sorry. This is your monthly cost, 12,000. So this is going to be quite a bit lower. Maybe it's $8,000 a month stabilized, $12,000 a month until you're fully leased up. So that's how you can play with those two assumptions to get your expenses going. So you see here, expenses starting here, and then we have our lease up costs, which will cover this initial period. And there's a lot of reasons why I wanted to make this dynamic and not just put the expenses starting in month 1. And specifically, there's just a lot of situations where you'll have once you acquire and if you raise rents, you might have some vacancy. There's a lot of reasons why there could be a space in there with costs that are not going to be what your stabilized costs are, but you still need to account for them until you get stabilized. So those are the costs, lease up costs. We also have options to finance. So here we're buying for $2 million. The seller financing loan is interest only. So let's say we did an seller finance. We did 60%, so we did 1.2 million at 7% interest rate. And then either the term is going to be equal to when you exit or the hold period, or let's say we can do 10 years. This model goes up to a max of 10 years. And let's say you do a 5-year term on the interest only, and then you refi at year 5. So in that case, you'd have to put the refi month in month 60 to match up with this. You can see on our seller financing schedule, we're paying interest only. And then at the end of the period, we're refinancing. This rate could be variable as well if you want to adjust the interest only rate over time. And then we got our stabilized refi until the exit. And then we pay that off. The other option you could do is a traditional finance, like a regular mortgage. Let's say this is 75% at a 5% rate for 30-year amortization. We can still refinance that. So if we go to the traditional waterfall or financing, you get your initial loan, you're paying principal and interest, then in month 60, we're going to refi. Okay, we refi at some higher amount, hopefully a lower interest rate, and then you go from there. Now you can adjust this. Let's say you didn't want to refi till month 72. You put that there, and now you can see on the traditional financing, now we're going till month 72. So this is all dynamic, and note both the seller financing and traditional financing have the same refi amortization schedule. This is not doubled up, and even if you use both, let's say some of it was seller finance, some of it's part of a loan, you can still do that, and the math is fine. It's only going to use one refinance. It's not going to do two refis. So if we look here at like the annual detail, you've got your traditional loan happening here. You've got the interest only loan happening here. And then here's the refi, which this is 17 million is just what you're refinancing on the single amortization refi schedule. Okay, so that is that. Let's say we're going to do seller financing. So let's zero this out. Say we're going to do 80%. You can see all the returns are updating as I update this. Now, if you did not want to do refi, that's also fine. You could zero that out or hit no. In that case, there's no refi happening, and then you just pay off either the interest-only loan or the traditional loan on the exit month. All right, so there's financing assumptions. Here we have the tenant assumptions up to 30. and you could put in each of the rentable square foot of the locations or tenant spaces, the annual rent per square foot, and this is existing. So note, there's existing and there's new. The existing is you might not be able to do anything with the rents for a couple years if they've already signed leases, and so you got to take that over. So this is to show you, okay, if you're going to operate on the existing lease for a couple of years, possibly for some of these tenants, or 5 months or whatever. So you put in what they're currently paying for rent. Here's the monthly rent row. Here's the yearly increase, because that's still relevant. Vacancy, just to count for turnover still, which could be relevant. And then the month existing rent ends. So you can see here, month 11, we have existing rent. So on our first tenant here, you can see it's going until month 11, and then it stops. And I just staggered these each month forward just to make sure my logic is working. But these could be whatever your scenario entails. So you can define when the month ends for the tenant and then when the new month rent starts. And there could be a delay in there, which will affect cash flow and returns and all that. But this does not have to be the next month. Like this could be month 15. And in that case, if we look at the new rent for the first one, we're starting here, not till month 15, but we're stopping on month 11. So there's a gap here where there's going to be no rent, which will reflect on the cash flow pro forma. You can see here's our existing rents. Here's the new rents. And then this is consolidated, adding them both up. Okay, so on the new rents, you just define when the rent starts, what the starting rent, base rent is per square foot per year. There's your square foot per month. Starting monthly rent, increase, vacancy. You've also got options, and the only reason why I'm putting a term in here, it's not because this is going to be up in 5 years or whatever, and the model's going to do anything with that. It's just to figure out the leasing commissions, which will be based on the term and the annual expected lease. So you can see on this calculation, leasing commissions, we're just doing a sum product of all the terms against the monthly rent times 12, so the annual rent, and then whatever your leasing commission is here will be paid. And this is an initial cost item. We already talked about stabilized expenses, GP fees. You've got an acquisition fee and an asset management fee. The asset management fee is just 1% against the amount of funds raised. Acquisition fee is just a percentage of the purchase price. General reserve, a renovation budget. These are just inputs that you can enter based on what you think you're going to have to do the, update the strip mall. Leasing commissions, tenant improvements. Now this one, leasing tenant improvements, what did I base this on? Oh, you can put in individually for each tenant how much you think you're going to spend on their location if you want to break it down like that, and that the sum of all of these will then populate here. You can define the exit month, whatever you put in here. Like if I put in, let's say, just a random month, 83, you can see the model will stop after 83 months. So whatever I put in there, it stops. Annual detail, same thing as a monthly, just an annual view. So here you can see kind of everything that's happening. Here's all your costs, your funding. Then here's your operations, cash flow, cash on cash return. Let's put this back to 120 months, 10 years. Exit cap rate, that's going to just go against your annualized NOI on the exit month. And then you got some selling fees potentially, and then that'll define how much cash you get on the exit. Cash requirement, this is just summing up all the different items above, so you can see itemized what's being paid for, how you're getting the money. Here's your financing, closing fees. This is just on the loan amount, so you can see against the loan amount if you have closing fees. Total cash required in this case is 2.9 million. And then based on, these rents are quite high for the purchase price. So you're investing 2.9 million and you're exiting for 83 million. Probably not realistic, but again, these numbers are just arbitrary. Maybe we lower these rents down, maybe to like $12 a square foot. Okay, IRR is still in the 50s and 40s here for the project. This is a project level summary. Your sources and uses. So we can see sources are investment amount, loan amount. Uses are all the stuff you're spending money on up front. These always equal. Here's a project IRR, equity multiple, exit price per square foot, total invested, total return, profit, return on investment. Now I did 2 waterfalls, and they're both set up like LPGP structures, or essentially an investor and an operator. The first one, option 1, you see here, is an IRR hurdle exclusive. So what that means is you have a certain amount of the cash requirement that's paid by the LP and GP, which you can define here. Let's say it was 95.5. You can see if I go down to the summary, 95 versus 5. The GP is obviously also going to have this acquisition fee to help offset their investment, and then the asset management fee. You can always zero these out if you don't want to include them in your deal terms. But what it's saying is, if the LP gives 95% of the cash, in that case it's 2.67 million, and the first hurdle rate 7%, what that means is in order for the GP to get to the next hurdle rate, which is obviously they'll have a promotion in the amount of cash they get, they have to reach 7% IRR for the investor. So in that case, we can see here's our check. The investor invests 2.5. They get back of the available cash flows here. They get back this amount. And in this case, they're getting 90% of all the cash flows. Let's say it's if it was 100, they get paid back a little bit faster. But they'll get 100% of the available cash flows until they've reached 7% internal rate of return. Now, internal rate of return means a return of capital plus compounded annual return of 7%. So that's what this is here. And then we reach that finally in year 3. Now we're out of this hurdle. So now the GP's going to get a promotion. They're going to get 25% of the cash flows instead of 0 in this case, until the LP has reached over 15% IRR. So we go down to, oh, there is also a catch up here. So like if we wanted to put an 8% catch up, that means that the GP, based on their initial investment amount, which they've invested 5%, which is in this case 133,000, they need to get enough money back to have this catch-up IRR, which in this case, so they get 168,000. That gives them an 8% IRR, and then we go to tier 2. Now, if you don't have a catch-up on the GP, you can just zero this out. Let's say we do have one for 8%. Okay, so now cash flows go to the GP. Now we get to finally tier 2, and here the investor is going to get, we can see how much cash they got in tier 1. This is the amount of cash they need in tier 2 to reach the next hurdle rate of 15%. So here we get 15% reached. Here's the amount that the GP is getting in tier 2, a little bit higher share than in tier 1. Then we go to tier 3, and the same thing, up to 20%. The cash is now split at 70-30. GP is getting a little bit more now, up to 20% IRR achieved for the LP, and so on. So that's the IRR hurdle schedule. The last hurdle is just 50-50. So after the LP's gotten a 20% IRR, we're going to split everything 50-50. Here's the exit IRRs and equity multiple for GP and LP. Also discounted cash flow analysis for each. You see the the GP fees here are included in their total distributions. The other waterfall is a preferred return simple. I do see this more, but it's kind of, it seems simple, but it's almost more complicated. I like this. This is very easy for me to understand and explain, but I do this a lot, so maybe that's why. But I'd say in the last couple of years, this has been more common with a simple preferred return. and then maybe after, basically there's a pref for the LP, not an IRR hurdle, just a preferred return. So they get a certain amount of cash. Once that's paid off, and you can accrue and or compound any unpaid returns, you can flick those switches off and on. Also choose to reduce the equity balance or not with profit share, which would adjust a preferred return. And then after that preferred return is met, and again, you have contributions here for the LP and GP, and then the split. So this 90-10 is saying after this preferred return is earned, so 100% of the cash flow goes to this first. And it's not an IRR, so they're not getting their initial equity back, and this is just the return, 10%. And then cash is split beyond that 90-10 until the LP has gotten their money back. And then you can do a second tier if you want to split it differently after they've been paid back. So you can see here 90-10 until they've gotten all their money back, and then the LP, and then 50-50 after that. Here's the final cash flows for the LP, the GP. You can see we still have the acquisition fees in here and everything. Also just kind of cash flow analysis. So that's the model. It's actually quite simple and elegant. I think you've got all your assumptions for the deal happening on the assumptions tab, up to 30 tenants. Then you've got your operating cash flow model. You've got 2 waterfall options. You could use one or the other. And you can delete, if you don't want to use both, you can delete whichever one you don't want. You've got your amortization schedules, and then the matrix tabs, which is where all the dynamic logic is happening. And that'll be it. I really like this model. It's giving some added value to the real estate template bundle that I have on the site. It's got stuff that I've never done, and is structured in a pretty nice way. I like how the financing is set up. I've never done a structure just like this before. So that's pretty interesting to me. And I think it'll be super useful for anybody trying to buy strip malls, renovate them, and then raise rents and then exit after a certain amount of time. Alrighty, if you want to check out the template, links in the description box below. You can get it at smarthelping.com under the real estate tab. It'll be included in this bundle here for $2.99. You can also just buy it separately. I'll probably price this template at $75 one-time fee. If you want to buy it just on its own, it'll be in the underwriting template section. And check out more. I've done all kinds of real estate models for specific industries. I'm pumped to add another type. So, we got mobile home parks here, hotels, assisted living, multifamily. Now I'm going to have strip malls. So that's great. Also, this one up top is super relevant for any unit-based. This is more for like self-storage, apartment buildings, multifamily, where you might have hundreds or thousands of units of different types, and you want to model out those deals. This one's really good for doing that. It also has a 3-statement model, and it has depreciation recapture. It goes a little bit deeper into the finances, not just cash flow, like the model I just went over. So have a look, check them out. A lot of these also are built for development or acquisition, so there's like a construction schedule and different things. And I also have, I've built probably now over 200 templates for different industries, a lot of stuff in the software as a service startup space. Obviously, a lot of real estate stuff, industry specific. I just went on a big kick the last couple months on renewable energy businesses, wind farm, biogas, EV charging. I still want to build that out, and I did end up putting I believe I put a renewable energy bundle where you could buy them all for a cheaper price. Yeah, for 99 bucks, you can get all 3 of those models. So I'm proud of that. I think it's super valuable. And then if you want to buy everything, you can get my whole library. I've got, like I said, hundreds of different templates here for all kinds of different uses that I've built. I've been doing this since 2015. You can download the full library for $9.99. Alrighty, like and subscribe. And I do want to say I have been probably busier than I've ever been in my whole life the last, I'd say, couple months, and it's just getting busier, which is wild because I did raise my rate to 195 an hour in January, and things have just gotten busier. So I don't really want to raise the rate again. I'm comfortable at that rate, but that's why I haven't had a ton of new content out. I've just been working a lot on stuff. There will be some templates coming to the Plus program. I only did one in May so far. I've got two more that I'm going to add tomorrow or the next day. So that's just going to be interesting. Um, but yeah, we're just gonna just keep building stuff to help people think about the economics of their businesses and plan. I will see you guys on the next one and take it easy.